Welcome to the Aramir Roundtable. Today is the 3rd of November, 2021. So welcome. I have a guest, Jason Leavitt, with us. Jason and I have some similar backgrounds, both growing up in Chicago, and we're both living in Colorado. So it's nice to finally talk to you, Jason, and glad to have you here.
Good to be here. Looking forward to talking to your group.
Yeah, we appreciate it. And I have to thank Rick Van Buren for introducing us. Rick is a subscriber and advocate of your work, so we're looking forward to that. Before we get too far into it, just a normal disclosure that Aramir Corporation is not a broker-dealer or an investment advisor. It's for educational purposes only. Options, futures, bonds, and currencies involve risks and are not suitable for all investors. Past performance is not necessarily indicative of future results. And if you want to read our whole disclosure, it's on the bottom of all of our websites, and I'll have it at the start of the recording. So you just pause the recording and read the whole thing if you want. So with that, I'll hand it over to you, Jason, and we're looking forward to it.
All right, thanks. All right, so I assume you can hear me well, and I can assume you see my slide.
Check, check.
All right, we are good to go. All right, so thanks for inviting me here. I'm going to do a quick intro about myself, and then I'll give, and then we'll get into the talk. So my name is Jason Leavitt. Been trading since '99. Went full time in 2002. It was during 2002 that I also launched LeavittBrothers.com, which is a research company that offers market analysis and trading ideas to the financial community. So we've been, we just had our 19th year anniversary. So that's kind of exciting. I am also the creator of a masterclass in trading, which is like an A to Z class. It's like everything you could possibly want to, not everything that you could want to know, but it's most of what you need to know. Whether you're a beginner, whether you're an intermediate trader trying to get over the hump, whether you're been around for a while and just need a few extra nuggets here and there. So I'll talk about more about those later. One, the research company, two, the masterclass. So I rather just get into the meat of my presentation here. You can see my slide here. If you want to contact me via email, you can see jason@leavittbrothers.com. On Twitter, I'm at Jason Leavitt. And then I've recorded over 100 videos and put them on YouTube. So there's a link to my YouTube account, and you can watch videos there if you want more information and more stuff. If something I say today kind of piques your interest. All right, so about this talk, I'm going to talk about playing bottoming patterns. So the purpose here is, or I should back up and I should say that when it comes to trading's hard, trading's very complex. Finance, worldwide finance is very hard, very complex. But the great thing about trading is that like you have the ability to zero in and just find something that works for you, something that really clicks with your personality, something that works. And then you could just zero in on that. You can study it. You can practice it, get really good at it. And you could do just that one trade over and over and over, and you can make a decent living as a trader. Okay. So as hard as it is, most professions require you to be good at a lot of different things. Trading is really hard. It's probably it might be the hardest thing you ever try, but it's nice that you can just find one thing that works and you could just do that one thing. So I'm going to present the format of what I'm going to present is I'm going to present a bottoming pattern. I'm going to talk through the different parts of the pattern, things I look for, things to look for. And then I'm going to show several examples of that pattern. And then I'm going to move on to the next pattern. Okay. So if you don't really like half of what I show you, that's fine. If there's one thing that I show today that kind of clicks with you that like, hey, that looks good, I could do that. Then you could just do that one pattern and be pretty much, I don't want to say you're set, but you could study that pattern, get really good at that pattern, and just focus on just doing that one sequence of steps, and you can make a living as a trader. And if you don't want to make a living as a trader, you can actually just use it to do whatever you want to do in the market, whether it be just make extra money in a retirement account or whatever. All right, so that's going to be the format. Show you a pattern, talk through it, and then show examples. And hopefully there's something in here that kind of clicks with you. And if you're not the kind of person that plays a bottoming pattern, that's fine. There's probably a couple nuggets in here that you could pull anyways and incorporate into what you already do. All right, so let's get into it. So the first pattern I'm going to talk about, and I don't have any fancy names for these things, so you'll see that. So the first pattern, I'm just going to call it capitulation down. and volume up. What it is you have a stock that's trending down, as you can see here, and you'll notice that these slides are very crude. I don't get them professionally done. I focus on the content of my presentation, not on these slides. So what you have is you have a weak stock that's trending down. Oftentimes it gets rejected several times by a particular moving average. And while it's trending down, as it gets towards its low, you'll get a very noticeable ramp up in volume, as you can see here. Okay, that ramp up in volume is followed by the downtrend is followed by a relatively quick recovery. Okay, as you can see here, while volume stays pretty strong. Okay, then the stock will consolidate, oftentimes above the very same moving average that rejected the stock on the way down, will then offer support, and then the stock will move out of that consolidation range and move up. Okay, so you got a weak stock that's going down. You get some sort of sign that the stock, capitulation takes place. Stock recovers on pretty strong volume. Sometimes there's a little bit of delayed volume. Then the stock proves that this is not just a bounce within a downtrend because it's able to hold up, and then it could move, and then it moves out of that range and legs up. Okay, sometimes these happen. Within a downtrend, you'll get a stock that's actually weak, moving down, doing down, 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 and then it'll actually, do this, consolidate and move up. Sometimes you'll have a stock which is moving up and it'll undergo what would be considered a downtrend within an uptrend, and then you'll get a pop off of there, a consolidation, and then move up. All right, so let's get into some examples here. All right, so here's HIMS. Okay, weak stock trending down. I should first say that the blue lines in all these examples, the blue moving average is the 50-day moving average, or the 50 moving average. The orange is the 21 EMA, and the light blue is the 8 EMA. All right, so next example, XPEV. You can see weak stock trending down. It gets rejected by the 50 here, more resistance by the 50 and the 21. You can have support here at like 30. It breaks down. Okay, and you can see the first 2 weeks of May here, how volume ramps up and is very strong. Then the stock bounces off a low, and right here, about third week of May, stock actually is able to establish itself above the 8 and the 21. Volume is steady, but not super strong, but then volume ramps up as the stock moves out of that range and continues up. Okay, so you have a weak stock trending down, volume ramps up on the way down, and volume tells you that traders are throwing in the towel. Then you get a strong rebound, able to establish itself above the 8 and the 21, which it was not able to do in the last bounce over here in April, and then it's able to move out of that range and rally from high 20s up into the mid 40s. Okay, so again, you only need one good setup in order to really make a living at this. So maybe this is your setup, or maybe it's not, but maybe you can grab a nugget and incorporate it into what you already do. All right, next. So here's Unity Software. Here's an example of a stock that was actually strong in an uptrend, but was undergoing a pullback within an uptrend. So if I looked way left over here to like April, March, the stock would have been down here. So it rallied up and it was pretty strong. And then this pullback here at the end of June, beginning of July, would be considered like a pullback within an uptrend. So stock pulls back, pulls back, pulls back. And you can see middle of July here, you get volume ramps up. Okay. And that's right at the low. At volume ramps up. It tells you that traders are, throwing in the towel. So anyone who is buying over here and they're thinking this is a strong stock, it's trending up, I want to just go in, and it starts pulling back. And at first they say, hey, no big deal, I got to, sit and ride a pullback. But then it goes down a little bit more and they get a little nervous, and it goes down a little bit more and they get more nervous. Pretty soon it takes out the 21. You can see the support was from the 21 here, the 21 supported here, but it takes out the 21 and it continues down, and then volume ramps up. That's the low. Stock bounces back. There's a delayed volume surge over here towards the end of July. Then the stock consolidates. It's able to prove itself over here by sitting on top of the 8 and the 21 for about 2 weeks, and then it moves up from there. Okay, so strong stock trending up, pulls back. The ramped up volume tells you that this is traders are throwing in the towel, and then the stock's able to bounce back, establish itself above some moving averages, and then moves up from there. So it's a good bounce play for for a stock that was strong. It was undergoing a pullback within the uptrend, and now is regaining its strength. All right, another example. Here is CAN. So, volatile stock, big moves in both directions. We can focus on in September here where the stock went down with force. You can see that there's a lot of huge volume bars on some of these down days. The stock then bounces back. Volume over here is pretty good. Volume over here, the first week and a half of October is pretty good. You can see the black volume bars are much bigger than the red volume bars. The stock then moves sideways for a couple of weeks to establish itself, and then it moves, and then there's huge volume out of that to continue on. Okay, so to summarize, you're looking for either a stock that's pulling back within an uptrend, or you're looking for a weak stock that's trending down. We don't want to guess bottoms. We just don't want to guess bottoms at all. There's more likely than not that a downtrending stock is going to continue down. But if you get a ramp up in volume that tells you the traders are throwing in the towel, and then you get an equally big surge in volume as the stock bounces back, establishes itself above a couple moving averages that had previously rejected the stock, then you got the potential for a move out of that range and a decent trade. Okay, it's just a trade. It doesn't mean the stock's going to trend up for years. It just means we have a tradable bounce taking place. And if you get good at that one trade, you could do this for a living. All right, so let me move on.
There was a question of how do you trade it? When do you get in? Do you set stop loss orders?
Yeah, that's that's probably like a whole nother webinar all by itself. I'm going to get into that a little bit in a few minutes as I pull up some indicators on some of these charts. But yeah, that's a whole topic in and of itself. So let me go on to. All right, so next one is what I just called a volume surge. Okay, and a lot of the bottoming patterns have, there's a lot of similarities. I don't have like a whole bunch of totally unique patterns. Like there are similarities. So in volume surge here, you have a weak stock trending down, getting rejected repeatedly, often by a certain moving average. Volume isn't necessarily anything noticeable. Okay, it's just a weak stock trending down. Then out of nowhere, you'll get a huge surge in volume as the stock is able to jump above a moving average that had previously rejected it numerous times. Then the stock will prove itself by staying above the moving average, and then it'll move out of that range. Okay, so let's look at some examples of these. All right, so here's Bitfarms. You can see kind of a chaotic stock, lots of gaps, lots of tails on the candles. It wasn't a very smooth moving stock. You can see it trended down here below some downtrending moving averages. Then we get here to mid-July, where it bottomed. Now you can see in the first couple weeks of July, there's nothing notable about the volume. There's no huge pickup in volume that would tell you that traders are throwing in the towel. It's just pretty much normal volume. But out of nowhere, the stock jumps, and then it spends 3 days holding those gains, and then it jumps again on massive volume. You can see on July 26th, the big volume bar. Then it spends 5 days consolidating above its 8 and 21 day moving averages, and then it moves up from there. Okay, so you have a downtrending stock that got rejected by the 50 here, got rejected by the 21 there. No question, it's a weak stock trending down, but out of nowhere, it jumps off of a low, rests, consolidates, proves itself, okay? Because if it's a weak stock trending down, it's probably going to go up and either get rejected by a moving average and then head back down, or it's going to go up, get above the moving average for a day or two, but then lose it. So by asking the stock to prove itself above these moving averages, that increases the odds of a successful trade. And then you can see the stock moves out of that range and volume ramps up. So these are just characteristics of the bottoming pattern that you can look for. Okay, next one, Bit Digital, weak stock trending down. You can see it got rejected by the 21 here at the end of April, rejected by the 21 in May, rejected by the 21 in June. And then it just continued trending down from there. And then out of nowhere, we got this massive volume bar and the stock doubled. Okay, stock doubled in 1 day on huge volume. It spends the next 4 days moving sideways, allows the 8 moving average to come up and offer a little bit of support. And then it broke out. It doubled over the course of like 6-7 days, I think. And you can see the volume you can see the volume on the right side of the chart, how strong it was. So a moving average, the 21, which had rejected it numerous times over the course of a couple of months, stock gets above moving averages, rests, and then continues up. So even if you like, this is a Bitcoin stock, even if you liked Bitcoin and you liked the stock, maybe you did some research, to me, I consider it unplayable. You have bounces along the way. Like here's a bounce in mid-April, but it gets rejected by the 21. You have a bounce here in May, gets rejected. Every bounce gets rejected. So instead of trying to pick a bottom and then stopping, and then stopping out and trying to pick a bottom and stopping out, if you wait for the big surge in volume for the stock to get above some moving averages, and then ask the stock to hold those moving averages to prove itself, then there's less, as I've said, there's like less upside available, because obviously if you buy down here at $4 or $5, the percentage move is much bigger, but the odds of success of trading of an entry below the moving averages is very small. Whereas if you wait till the stock pops on huge volume and then consolidates for a few days, there's less meat on the bones, but your odds of success are much higher. All right, so let's go to another example. Here's 3D Systems. All right, here you got a weak stock trending down. You got rejected by the 50 over here in March, rejected by the 21 a few days later, rejected by the 21 in early April, again, rejected by the 21 in late April. Then we get, a lower low here, but then out of nowhere, we get a huge volume day and like a 30% gain. The stock then spends the next 4 or 5 days consolidating, proving itself, and then it moves up from there. Okay, so we have this, we have a bounce here in the second week of March, but it got rejected by the moving averages. We have a bounce here at the end of March, but it got rejected. We got a bounce here third week of April, it got rejected. But then this bounce, what makes it different than the others is, one, we have huge volume, and two, the stock is able to get above some key moving averages, hold those levels, prove itself, and then move up from there. So if you're buying the stock at 22, 23, 24, stock goes up to the low 30s, that's a great trade. Okay, so instead of guessing a bottom, instead of trying to predict a bottom, instead of just thinking like I got to buy and then stop out and buy and stop out, buy, stop out, which could work eventually, but those types of paper cuts really add up. If you wait till the stock jumps on high volume, proves itself above some moving averages, then you could make, then you get the second leg. Okay, and the second leg is not going to be as big as the first and second leg combined, but the odds of your success are much higher. Let's move on to another example. All right, here's Fisker, weak stock, trending down, obviously. Couldn't even get up to the 21 there. Here's a bounce at the middle of April. Couldn't quite get up to the 21 there. Lower low, second week of May. Nothing down here says capitulation. Okay, and then out of nowhere you get 3-4 really big volume days in a row as the stock comes up and finally gets above first the 8, then it moves sideways here, and I'm talking about the last 2 weeks of May here. Then it moves sideways for 5-6 days above its 8 and 21 moving averages to prove itself, and then it moves up from there. So it moves up from $13 all the way up to 19. So again, an example of a trade where I'm not going to guess a bottom over here at the end of March. I'm not going to guess a bottom over here in the middle of April. I'm not even going to guess a bottom here in the middle of May. But if I wait till the stock moves up on volume, then moves sideways into some moving averages, then I can get the second move out of that pattern. And you can often get a 10, 15, 20% move, sometimes even more. All right, let's go to another example. All right, here is Fubo TV. So weak stock trending down. It got rejected in third week of March. It got rejected by the 21. In April, it got rejected by the 21. Then the fourth week of April, it got rejected by the 21. So we're not guessing bottoms, we're not predicting bottoms, but if we wait, you can see in May, it jumps on huge volume. You got back-to-back huge volume days down here at its second week of May. Moves, that kind of jerks the stock to life, and then the stock moves sideways for about 2 weeks to allow these moving averages to come over and support it, and then it moves up from there. So you got to trade from like 22 up into the 30s. Great trade. Okay, there are other aspects of this. You have like a little head and bottom, a head and shoulder bottoming pattern. So like, hopefully you can see this, where you have like a dip here and then a bigger dip here and then a consolidation pattern here. So you can draw a trend line right over here. just above 22. So it's a really good pattern to look for. So you not only do you have the head and shoulder bottom pattern, but then you have this big volume surge on the right side, and the ability of the stock to prove itself by sitting on top of these key moving averages. Then when it moves up from there, it's a pretty easy trade to take. Certainly for somebody who hesitates with trading and they're not really sure if they should take it, like this is from a technical standpoint, this is as good as they get. And, because the last few days here are pretty tight, you can actually have a reasonable stop. All right, let's look at another example. So here's Gevo weak stock, got rejected here at the end of March, beginning of April, at the 50. Then it gets, we got a bounce here the third week of April, but it gets rejected by the 21. And then, lower low, nothing down here says capitulation. Nothing down here says traders are throwing in the towel. It's just a weak stock trending down. And it probably wouldn't even be on your radar. Then it has 3 huge up days in a row. You can see volume is huge here where the stock comes to life. Then it spends about a week trading sideways above these key moving averages. Okay, so the same moving average that rejected over here is now supporting it over here. So once it proves itself up here, dips within this range can be bought, and then you can add on a breakout. And you can see, even if you just play, a stock from 7 up to 9, that's on a percentage basis, that's a pretty good move. If you get really good at just this type of a trade, okay, this type of a trade being weak stock trending down, but then it comes to life on strong volume and proves itself above some key moving averages, just trading that second leg, you can make a pretty good living. Even if the stock were to roll over here and go back down to 7, 6, 5, maybe it makes a new low, that's fine, because a lot of weak stocks will bounce 30, 40% within a downtrend, and you could, so there's money to be made there. All right, let's look at one more. All right, here is Plug Power, similar situation. We have a weak stock trending down, rejected by the 21, rejected by the 21. We do have some rally attempts, but each one gets rejected by the 21. There's nothing over here that says, huge volume, huge capitulation, everyone throwing in the towel. But what you do get is you get a big move here, second week of May. Okay, stock rests for 2 days, and then you get a huge amount of volume to the right over here, the second and third week of May, as the stock moves up, moves sideways, proves itself above some key moving averages, and then it moves up from there. Okay, so for whatever reason, if you like the stock, I don't consider it to be playable. Like there are bounces within the downtrend that's always going to take place, but each one of these bounces gets rejected by the 21. So I wait. Let me have a volume move above the 21. Let's have the stock prove itself, and then I'll play the second move, the second leg of that bounce. All right, now let's, I'm going to skip a little forward. All right, so what I've just talked about is downtrending stock. Sometimes you get capitulation and then a strong volume move off the low. Sometimes you don't get any capitulation, but you still get a strong move off the low. All right, so let's go on to the next one. Here is what I just call a breakout from a base. You have a stock which is essentially dead. Okay, it's been trading in a base for a long time, sometimes a few months, sometimes for many more, sometimes 5, 6, 7 months. Rallies get sold, dips get bought. It's completely nondescript. There's nothing interesting about the stock. There's absolutely no reason to play it. There's just simply no reason. Volume doesn't suggest anything. Then out of nowhere, the stock will break out from the base on strong volume. Okay, and you can see what I attempted to draw here. You get a huge jump in volume. The stock breaks out of the base, proves itself above some key moving averages, and then it moves up from there. Okay, so again, like I said before, a lot of these patterns have some similarities. There's definitely some crossover. So some of the stuff I'm going to tell you is going to seem a little bit redundant, but that's fine, because in order to get good at something, you got to do it over and over. Okay, if one of these patterns looks good to you, your next step is to go look for them. Go find 500 of them and build yourself a little bit of a library, and then flip through them one at a time in order to train your eye to be able to find them. All right, so I don't mind being a little bit redundant with these. All right, so here's an example. Here's CAN. Over the course of several months, it was pretty much a dead stock. You can see a lot of small candles, not really much directional movement. Just kind of a dead stock, trading near its lows. You can see all the moving averages are basically flat. You had a little attempt to move up here, which was probably, it wasn't playable because there's no reason to even be watching the stock in the first place. But like this stock might show up on your radar. You might do a screen at the end of the day and find this stock. But then obviously the next 2 days, it just goes back down. So you have a big range here, not a big range. You have a big base here with the top being at about 275 going all the way back to here. Okay. But it's not until you have this November 16th big move on huge volume that the stock breaks out of this entire base. Okay. Then the stock trades sideways for 3 days to prove itself, and then it moves up from there. Okay. So similar to the others, you have a big base. This stock is not very interesting at all, completely nondescript. It's not even on your list, but then it comes to your attention because of this big volume breakout day. Stock then moves sideways for a few days, and that makes it playable. Okay. You can buy a dip within the range or wait for a breakout. All right. Let's go to another example. All right, here's CFLT. Stock went public here in June, obviously did really well initially, but then it came down, and you can see it just had a really kind of a small base here. Okay, then it pops off the low of the base right over here at the beginning of August. It spends 3-4 days trading in a relatively small range, and then you can play out of there. Okay, so even if you knew the stock, you knew it went public, you were watching it, you didn't know how to play it, you can see the big move down off the high, and it's just basing. But when you get a solid up move like this, and I don't have the volume here, when you get a solid move like this, that's where it actually kind of comes to your attention. You can see a resistance. You can draw a resistance line here at 42. Spends a couple days proving itself, proving that it's not going to just go right back down. You can see this day on the 26th where it actually attempted to move up, came back down, finished weak, and then continued lower. On this day, it finished near at the high. It finished at the high. It was able to hold those gains for several days and then move up from there. Here's another example: Hut Mining. A lot of these are trades that we've done at Leavitt Brothers just in the last couple months, which is why I'm using them here. It's actually fairly easy to come up with a lot of examples for this talk, is because there have been so many good trades to be had recently. So you have Hut trading in a range, again, completely nondescript, nothing interesting. There's no reason to play it whatsoever. Trading in a range, not in a range, trading in a base, and then out of nowhere, it pops up here. You can see at the end of November. Okay, that brings the stock to life. That probably puts the stock on your radar. If you do any type of volume scan at the end of the day, this stock would show up. If you do some sort of like percentage gain scan, this stock would show up because just on this candle right here, the stock moved from it's probably like $1.08, $1.09, all the way up to like $1.40 something. So it would certainly show up on some sort of scan. Then you get a nice pullback, holds the moving average, and then moves up from there. As far as entries go, somebody had asked, how do you time entries? I use my two indicators that I use to time entries are the MACD and stochastic. So in this case, the stock moves up and moves down, and like in here, you're wondering like, when do I buy? Because in hindsight, it looks like you can just buy and it'll go up. But like when the stock trades in a tight range for 3 or 4 or 5 days, when do you actually buy? I use the MACD and and the stochastic to time entries. Okay, some of the things I do is I'll draw trend lines on the stochastic. Okay, and I also look for the stochastic to curl up. Those are the two of the things I look for, and I also look for confirmation from the MACD. You can see the MACD crossed up here, crossed back down, but then recrossed up here. So I would be looking at the recross here, as well as the fact that the stochastic had already crossed up. Okay, and I'll as I show more examples, I'll point these things out to you. So here is Copen. You can see traded in a base, completely nondescript, nothing interesting about it. Stock pops here at the beginning of November, or at the end of November, moves sideways, gets support from the 21, and then moves up from there. So it really didn't, but then it didn't really break out of its entire base until third week of December here. So actually moved up, came back down, tested the 21, moved up, came back down, tested again, and then moved up from there. So as far as using the MACD and stochastic to time an entry, one of the things I look for, it's something I teach in my master class, is it's setup I call my kiss and cross trade, where what'll happen is the MACD will cross up, and then it'll on a dip here, you see the end of December dip, the MACD will come back down, touch its signal line, and then move off of there, so that you get a little bit of a kiss there. And when that happens at nearly the same time as the stochastic crosses, that's why I call it my kiss and cross trade. So you get a kiss over here at the MACD, you get a cross over here with the stochastic, and that from a timing standpoint, that's how I use to time some entries. Okay, so you're not just guessing. A lot of these examples look really good in hindsight, but they're not as easy in real time. So that's how I would, it's simple tools to help time entries with the MACD and stochastic. All right, another example. Here's Riot Blockchain. Obviously, big base here for a couple, for several months. Out of nowhere, the stock pops. Volume is good. Then the stock moves sideways here. Okay, it looks like, it's definitely trending up. It definitely has an upward bias, but you can see here, over here towards the end of November, the price was actually unchanged going back, 6-7 days. Okay, so stock pops in strong volume out of the base, moves sideways, establishes itself above some moving averages, and then goes up from there. Let's go one more example, and then I'll move on to the next one. All right, here's SLI. Again, base, completely nondescript, not interesting, no reason to play it. There's just nothing to do. But then what happens is the stock moves up here towards second half of June. Okay, so resistance here was probably somewhere in the 375 area. So it moves up here, moves sideways end of June, beginning of July. Okay, and then it moves up from there. Okay, so again, a base which is not tradable, but then when the stock moves out of the base on strong volume and then can establish itself above some key moving averages, then the next move up becomes playable. This is also a good example of using the MACD to time an entry. You can see the MACD crossed here, second week of June, trended up. You can see the black MACD line comes down, kisses the red line, and then moves up from there. So I would use this as a timing mechanism to enter the trade, because the stock's just kind of grinding up. Then it moves sideways for 4 or 5 days. Then it actually drops back. Then it moves up. And from a timing standpoint, I'll use the MACD to time my entry. And then as I said a minute ago, I'll also draw trend lines on the stochastic. So if I could draw a trend line from here through here into here, at the same time the MACD is kissing over here, the stochastic is breaking out of my trend line there. So that helps you, you recognize that this is a stock that is coming to life. It can trade in a base. It's not very interesting, but then it moves out of the base and you're thinking this is the beginning of a bigger run. I want to get in, but you don't know how to time your entry. I'd recommend using the MACD and the stochastic to time your entry. All right, let's move on. All right, so here next up is a double bottom pattern. It's a rolling double bottom pattern where the first, weak stock trending down, or it could be just a stock pulling back within an uptrend. On the first move off a low, it gets rejected by a moving average. Then it comes back down and tests the low. Then the second move up, it finally gets above the moving average, establishes itself above the moving average, and then moves up from there. Okay, so I love it when a stock proves that a moving average is an important level to key in on by getting rejected by it once, but then that same moving average offers support at a later time. So let's look at examples of this. So here's Alcoa. If you could look at June and July, you can see starting here in June, stock moves down. There's a bottom, comes up, gets rejected by the 50-day moving average, comes down again, but then comes up here, establishes itself above the 8 and the 21 moving average over here. We're talking about end of July, beginning of August, and then it moves out from there. Okay, so this rolling double bottom pattern, we got a low there and then a low there. It comes up, establishes itself above some key moving averages, and then it moves up from there. Now, the fact that it dropped back down is irrelevant. Okay, some of these stocks are gonna form these sequences, and they're gonna go pretty far. Some of them are just going to be just trades. It's just a trade. You're in, you're out within a couple of weeks. You take your money and you're done. So if if this is a stock that you bought at 39.40 and it goes up to 45, you probably get stopped out over here near 44, and that's just the way it goes. Okay, but that doesn't negate the fact that the the setup was there. So here's AEHR, big move up mid-July. You can see this comes back, comes down end of July, beginning of August, comes back up, then swoops back down again, and then comes back up. And then you can see here, end of August, beginning of September, it consolidates at a higher level and then moves up from there. So this to me is pretty much perfect for it to come down, and we have a bottom here, and then second bottom here, and then establishes itself at a higher level. It's not always at a higher level, but establishes itself above some key moving averages to prove that it's not going to go back down. And then you get a trade out of that range and upwards. So that's a really good example. Let's, okay, here's another good example, YMM. It's a Chinese company, stock moved down, moves up, gets above the 21, but falls quickly, comes back down, and then comes back up, establishes itself at, above some key moving averages here, and then moves up from there. Okay. One thing that often happens besides the first move here at the beginning of August, most of the time you'll get rejected by the higher moving average. Sometimes it gets above, as is the case here. But most of the time it'll get rejected. But what'll happen is on the first move up, you'll have the 8 come up to the 21 and then fall away from it. Okay, so if you look at it, the end of July here, there's a big gap between the 8 and the 21. So the first move up pulls the two moving averages kind of close together, but then they fall off. And then the second move up is forceful enough that the 8 will cross the 21, stock will establish itself and hold that level and then move up from there. Okay, so that's something I look for. It's something I talk about and teach in my masterclass. All right, one more example here, because one more example here, and then we'll move on to the next one. So here's GLBE. Everything I've showed you so far has been on a daily chart. This is a 15. Okay, a lot of these patterns form on intraday charts, especially this rolling double bottom pattern. So it's a 15-minute chart that covers 3 days. So if you look over left here, the stock is weak. It's trending down below its 8 EMA, comes down, forms a bottom, 1 o'clock, 1:30, comes up towards the end of the day. At the beginning of the next day, it comes back down, tests near the low, then it moves up again. Right over here, it establishes itself. It closes. It forms 3 entire candles above the 8 and the 21, and then it moves up from there. Okay, so you have this like bottom here, comes up, bottom here, comes up, establishes itself above the key moving averages, and then it goes up from there. Okay, and as you can see on this particular day, if you're long at 67 and a half, at the end of the day, it closes up near 70, and then the next day it's up in the mid 70s. They don't all work out that well, but a lot of them do. This is also a good time to talk a little bit about my kiss and cross trade, which I briefly mentioned a minute ago. So what'll happen here, okay, on the last slide, I talked about like the first move up here coming up where the 8 and the 21 get squeezed together, but then they fall off, and then it's the second move up where they actually cross. The sequence with the kiss and cross oftentimes overlays on top of this. So the first move up causes the MACD over here to cross, and the stochastic is already crossed up. So both the MACD and the stochastic are now trending up. Then the stock falls back down, but you can see, and when it falls back down, what will happen is the stochastic will rotate down. Okay, but the MACD will only come down. It'll stay above its signal line. Okay, so the black line will stay above the signal line. So right over here, you get the MACD will come down, kiss the red line, and then start to move off it at the same time that the stochastic will cross up. So that's what I call my kiss and cross. So the first move up causes both of them to cross and trend up. The subsequent move down has less energy than the move up. So the MACD will stay crossed up, and the stochastic will just cycle down, and then you get a kiss over here with the MACD, and you get a cross over here with the stochastic, and then that helps you time an entry. All right, one more example. This is a 5-minute chart, Palantir, so this entire chart is 1 day. Really quickly, stock moves down. You get a bottom here at about 11:10. Stock moves up, gets rejected by the 21, comes back down, okay? And then it moves up again, establishes itself above some key moving averages, and then goes up from there. All right, let's move on to the next pattern. Okay, so the last one was a rolling double bottom pattern. This is just a rounded bottom pattern, okay? Similar characteristics, except just slightly different formation that you could look for. So I'm not gonna go into details here because it's the same as the last one. All right, so here's an example with advanced micro devices. You can see at the beginning of, right, during May here, stock had, broke out, but then came down. We have this bottoming, like rounded bottom pattern here through the second and third week of May. Okay, hopefully you can see that. Then the stock establishes it, moves up. We got pretty good volume here. The stock trades sideways over here for 6 days, establishing itself above some moving averages, and then it moves up from there. Okay. Okay, here's CFLT. I use this as an example on another slide. But if you come all the way over here to the left side of the chart, like third week of June, where my mouse is, you can see this. This is a big swooping bottoming pattern. Okay, resistance here at 58. Okay, other than this 1 day right here, you got really good resistance here at 58, and you got this like big swooping bottoming pattern here. Okay, so same thing. The stock moves up, proves itself by establishing itself above some key moving averages, and then moves up from there. Okay, so instead of looking for a rolling bottom pattern, you're looking for just a big swooping, a big rounded bottom pattern, and hopefully there's some stronger volume on the right side. And then you want, on the right side, you want the stock to prove itself and establish itself above some key moving averages. That gives you frame of reference. You could buy dips within, whatever forms over on the right side. You could buy dips within that range, and then you could add on a subsequent move up. All right, here's HUT. A lot of things going on in this chart, but I will just focus on just the bottoming pattern here. And obviously, you got kind of a double bottom pattern here. That could be a pattern. You got move down here in June, then move up, move down, move up, and then establishes itself right over here above some moving averages. So you can play that, but I'm focused on this bigger swooping kind of bull pattern here with resistance somewhere up near 7. Okay, so you can see how that goes. You get weak stock trending down, then you get a stock that slowly trends up, establishes itself above some key moving averages. Volume typically is going to be strong on these moves that move up, and once it establishes itself up here, it could be hard to buy a breakout over here because you're thinking, hey, the stock was just at $3.5, $4, $5, and now I'm supposed to buy at 7. Well, when you have a big rounded bottom pattern like here, the big forceful move tends to start after you take out key levels from months ago on the left side. Okay, so the trade isn't over. Just because the stock has already doubled off the low doesn't mean you've missed a great opportunity. Oftentimes there still is a lot of upside to go. All right, so we're going to go through one more pattern. This is what I call my throwback. So all the patterns I've shown you so far, whether it be a rounded bottom pattern or a rolling double bottom pattern, or just a base that the stock breaks out of, a lot of them you can see that they're forming ahead of time. You can see them day by day, week by week, that a certain sequence is forming. Sometimes you get stocks that are just completely nondescript. There's nothing interesting. Maybe they gap too much. Maybe the tails on the candles are too big. Maybe they just don't trade smoothly. But out of nowhere, they break out and they rally. And because you weren't paying any attention to them, you can't really play them. There's just no way. You have your watch list. It could be 3 or 4 or 10 stocks. And obviously there's thousands of stocks out there. So there are going to be stocks that come to your attention after they break out and after they run up a bunch. And the tendency would be to say, what am I going to do with this? I'm not going to, it broke out at 40 and it's already at 47. I can't chase it. Well, oftentimes there's a throwback. There's a correction back to a key moving average that gives you a second opportunity to get in. Okay. So there's no way you're going to get the first move because you weren't paying attention to it in the first place. And there was no reason to pay attention to it. But then you get a move. But then if you continue to watch it, maybe there's a move sideways into some moving averages. And that's what a lot of these other patterns talk about. Or maybe if you're lucky, there'll be a throwback to a key moving average and an opportunity to play it several weeks later. So let's look at some examples of this. All right. So here is AMD. Stock was just kind of rolling around in a base. It was moving up, it was moving down. There was no momentum in either direction. And then out of nowhere, the stock at the end, second half of July, the stock rallies up. Volume is strong, the stock rallies up. But because it wasn't on your list, maybe you just missed it. You weren't paying attention to it. You're watching something else. There were trades elsewhere. By the time it gets up here to the mid 90s, you're thinking, okay, I can see this stock is probably going to move up from here, but I don't want to chase it higher because it was just at 80. It was just in the high 70s, and I just don't want to buy it up here in the mid 90s because it's just too late. So if you wait, as you can see here, the stock dropped. The stock came down, found support at the 21, lost that, and then it bounced from there. And that's a good example of a stock that broke out. You didn't want to chase it higher, but if you give it a few weeks, it dropped back, bounced, came up here. You got 2 tests over here at the 21, and then it moved up from there. Okay, so a pretty good example of a stock that, like, maybe you missed the first move, but it gave you a pretty good opportunity to buy it again 10 points off the high. All right, here is BTU. Again, stock was kind of nondescript in a group that doesn't get a whole lot of press. It would not be on your list. And then out of nowhere in the middle, at the beginning of May, it just ramps up on huge volume. It goes from $4 all the way up to 8.5. Okay, so you completely missed that move. There's unless you were watching it, unless you follow the coal industry really closely, there's no way that you're going to play that because it just would not have been on your radar. So, but you don't have to give up on it. Maybe you get lucky, and in this case, you did. Like, you can see that the stock, dropped back over the course of 6 days, found some support at the 21, and then bounced from there. Okay, so this nothing. It's less of a pattern and more of a, you're going to miss a lot of stocks. You're going to miss the first leg of a lot of stocks. If you do some scans for like volume gains, strong volume or percentage gains, you're going to see a lot of stocks that have already broken out, and you're not going to want to chase them. But if you continue to watch them, sometimes you get a move sideways that enables, some moving averages to catch up. And sometimes you'll just get a pullback to some key moving averages that give you a second chance. So here's LAC, stuck in a range, not doing anything. And then out of nowhere in the second week of August, it ramps up on huge volume here. Okay. You don't want to chase it higher. You just had an opportunity to buy it at 13, 14, just 2 weeks before. You don't want to chase it higher at 17, 18, 19. It goes up day after day. You can see, like, strong day here on August 9th, and the next day it gaps up. And then the next day it gaps up again, and the next day it gaps up a little. And you just don't want to chase it higher because it's not really a high beta stock, and you don't think it's going to like just run up into the 20s. So you watch it, and you see you get another chance down at the 21 a week later. Okay. So it happens. It's not going to happen all the time. Okay. Sometimes stocks will break out and just run, and you won't be able to play them, or they'll act in a certain way that just makes them not playable. It happens. There are thousands of stocks out there. Luckily, to do this, to make a good living doing this, you don't really need that many trades at any given time. You just need, a couple at a time. So you're going to miss some of them, but occasionally a stock will run up like this, and you'll get a second chance. A couple more examples here. So here is RSI. Okay, stock is weak, gets rejected by some moving averages here. Obviously, it comes down here. And then let's say on this day, it showed up on one of your scans. So the stock pops on huge volume. It rallies from, rallies like 10% in one day. Volume is really strong. So you're thinking, hey, if this thing can move sideways for a few days, I'm going to play this one. And then what happens the next day on August 9th, it gaps up, and you're thinking, great, now what am I going to do? And then it moves up, it moves up again, and moves up again, and moves up again. And you're thinking, great, I noticed the stock over here in early August. I wanted to play it. It was on my radar, but I didn't get a chance because it gapped up and ran. Well, a week later, it pulled back to the 21 and the 50, gave you a second chance to get in, and then it went. Okay. So the whole point here is that you're not going to, for a lot of stocks, you're not going to recognize them until after the move starts, but oftentimes there's a second chance to get in. Let's do one more. Here is any. So stock was trending up, got support at the 21 here, support at the 50 here. Even though it was trading in a range, you can kind of sense some upside momentum was like building here. In fact, you can, look at this one with resistance here. You're getting squeezed here. You got the 21, 8 and the 21 below it. You got 3.5 as resistance above it. You're thinking this could be a good trade, and maybe it trades in a larger pattern here and then breaks out and runs. and then it gaps up. So again, you're thinking, hey, I found the stock, I really liked it, I wanted to play it, but then it gapped up and I wasn't going to chase it higher. Well, 2 weeks later, it pulled back, found support at 21, and then gave you a second chance. Okay, so that's that's my presentation. That's what I have for you today. Bottoming patterns with technical indicators. There's a lot of different formations that form, whether stocks are weak and then pop on strong, and have capitulation and then pop, whether they just have nondescript volume and then they pop, whether they have a rolling double bottom pattern, or just a big bull pattern, or just they break out of a base. I'll have similarities, but in all cases, you're looking for a stock that was either weak, trending down, and then just surges on strong volume, and then either moves sideways to prove itself, and then you can buy dips within that range for a second leg up, or sometimes they do a throwback and come back down to a key moving average. Okay, if there's one thing in here that kind of clicks with you, like, that could be your trade. Okay, as I've said several times, you don't need a lot of trades, you don't need to know a lot, you don't have to have a PhD in finance, you don't have to work for an investment bank. If there's just one trade that kind of clicks with you and works, you could study that trade, get really good at it, practice it, and that one trade could make you a lot of money over the next 10 years, 20 years, 30 years, however long you want to do this. So with that, I'll throw it back to Tom, and maybe I'll take a couple questions. I think we're at the hour mark, so I don't want to stay too long.
Yeah, there was a question. Do you have a scanner to find these patterns? Finding an individual stock is like a needle in a haystack.
My method, I don't use this. I don't have a scanner. I like to look at stocks. Some people use a top-down approach where they look at the indexes, look at groups, and they go from there. I use a bottom-up approach because I think by looking at, like, say, 500 charts, every other day, it gives me a really good intuitive feel for how strong the market is or how weak the market is. So I actually will flip through several hundred charts, and my eyes at this point have been trained to see these patterns. So I don't have a special scan that I do that will spit out like here's 5 double bottom patterns. I just flip through a lot of charts, and my eyes are trained to find them.
And I guess you have your master class and then also your subscription service. And I know you had a special offer for that.
Yeah. So for my subscription service, again, we've been in business for 19 years. We offer market analysis, trading ideas to the financial community. Whether you're a new trader who is like just learning, I mean, if you subscribe to the service, it kind of gives you a chance to pull up a chair next to some really good traders and like kind of like watch and see how they operate. You could be a trader who's been trading for a couple of years but can't quite seem to get over the hump, or you can be somebody who's been around for a while and you're really good, but you're tired of spending a lot of time doing research. You kind of want somebody to do that for you. So we've had a lot of traders, 19 years we've been in business. So the offer I was gonna make to Tom's group here is just if you want to subscribe for a year, I will throw in an extra 3 months for free. Okay. So you can go to the website, leverbrothers.com. There's a video on the homepage that you could watch to get an idea of what the service is and what we offer. And if you have any questions, you can contact me. And also, all new subscriptions come with a 2-week free trial. So even if you're not even really that interested, you could still check it out just to kind of get a general idea. And then the masterclass, there's a link in the top navigation of the page here, or maybe you can see my
Yeah,
cursor.
I see it. Mm-hmm.
So the masterclass is like an A to Z class. It's the class I wish I had when I was starting. It's the class I wish I had after I had gotten started and was like wanted to get over the hump. It's everything. It's literally me sitting down with a blank piece of paper saying, what do I, what do I, why am I successful? What have I done? If there was a class I could take, it could have, if there's a class that I wish I would have had access to at the beginning, what would it be? And so I put the class together. And so you can go click on the masterclass link at the top navigation and get an overview of that. I don't have any specials for the class. I have a special for the subscription service, but no special for the class. So in either case, if you're interested in the Leavitt Brothers, you can go to the homepage and just watch the video there. If you're interested in finding more information about the masterclass, you can click on the masterclass link on the homepage there and get information about that.
And as far as actually, if somebody wants to take you up on your subscription offer, is there anything special they need to do, like send you an email after they subscribe? Does he?
No, I'll see it come in. So they could just subscribe on an annual basis, and then they'll get a 2-week free trial if they're a new subscriber, and then I'll manually add on the extra 3 months.
Okay, so they don't need to reach out to you.
They don't need to.
You-
If they want to reach out and just to say hi and say, tell me how they, tell me that they heard me speak at, here, that'd be great. I
Okay,
like to get to know them, but they don't have to.
sounds good. All right, well, that's all the questions we have, and like you said, we're a little over an hour, so probably a good place to wrap it up. And I really appreciate you coming on and showing us those bottoming patterns, Jason. They were very interesting.
Thank you. I appreciate the opportunity, and sorry that the me drawing on the charts didn't work. I don't know why it didn't.
Well, even in 2021, there's still technical issues, right? All right. Well, thanks very much again. And thanks everyone for coming. And we will see you soon.
Great. Thanks again.
Thanks. Bye.
Bye.